afternoon, everyone. Welcome to today's webinar. We highly recommend that you grab yourself a pen and paper, a glass of water, or your drink of choice, because we're going to be here for a little while. There's a lot of information to share with you today. We're going to be having a Q&A in the middle of the presentation and towards the end of the presentation so that we can get through all the great content that we have to cover for you here today in regards to financials and how to get ready to apply for grants and the PPP loan. But primarily, we're going to be talking a lot about your business financials. My name is Samalit Hogan. I'm with the Small Business Development Center Network. We are small business advisors that provide one-to-one confidential business advisory services to all businesses based out of Massachusetts, existing and new businesses. I want to thank all of our other organizations here, collaborating organizations from the Western Mass, Means Business, Collaboration, SCORE, the Center for Women Enterprise, Common Capital, Valley Community Development, and Franklin County CDC, including the Small Business Development Center. All of these organizations have collaborated in bringing you this programming. So we're very thankful for their support, and all the contact information is on the screen. Here's the listing for all the offices throughout the state for the Small Business Development Center. And you can find out this listing on our website. So if you need assistance with the PPP or with applying to grants, please reach out to the office closest to you. The way to do that is to put in a request for counseling form online. This is our request for counseling form here in Western Mass, but other offices will have different links. And without further delay, I want to introduce Rob Morton. Rob, thank you so much for joining us today. It's a pleasure to have you here today. Rob Morton has 35 years of experience in public and management accounting. He has a bachelor's of science degree in accounting and finance from the University of Maine and a master's degree of science in professional accounting from the University of Hartford. He also has received a master's in taxation degree from the University of Hartford. So yeah, that's a lot of master's degrees there, Rob. You were in school for quite a while. So welcome. Thank you for doing this for us today. Go ahead and unmute yourself and take it away.
Okay, I believe I'm unmuted.
Yes.
And I do have the slides going through this. This is normally a 3-hour course that we do, specifically dealing with what's on different financial statements and having you get a better understanding of financial statements. We're prepared today during the Q&A to talk about the requirements for some grants that are being out there, and also the next round of PPP2, where you have to give some very specific information to know if you qualify for those or not. And we'll be fully prepared to answer any questions about those items today. So, but again, this is a course, normally it's done around a round table with 10 people. So this is a very different format than we've ever attempted before. It's a lot of information in a fairly short period of time. We'll have some breaks, and again, and you have the question and answers that we'll have a couple different Q&A periods so we can stop and cover your questions. Normally we go around and introduce and ask, why are you here? We simply don't have the opportunity to do that today. So we'll try to adjust on the fly as we see what some of the questions are coming up. So we just want to start off with, basic definition of what is accounting. We're a different breed of person. We gather and report on financial information of a company. A lot of you consider accountants to be our necessary evils, because you have to do tax returns, you have to do financial statements for your bank, and we want to give you an understanding of what we're doing. So we capture financial information, we organize it, and we produce financial reports. We want to summarize your business activity for the entire year and present it in 1 or 2 pages so people can understand how they're doing. A lot of people are going to use your financial statements. Number one, the most important use of the financial statements is for you, so that you can better run your business. It's important for you to know what you're making money on, what you're not making money on, where your cash is going, is your balance sheet what it should be for your business. And then there's a whole bunch of other people that use your financial statements. People, if they invest in your company, your banks, your creditors, The taxing authorities, regulatory agency, customers may want your financial statements if they're going to loan you credit and things like that. If you're involved in labor unions, they're going to want to see your financial statements. In this day and age of COVID and all the grants and all the financial packages that are out there, there's a lot of people that want to see your financial statements, and not just on an annual basis. They want them broken down. One of the grant worksheets we'll look at later today breaks down your revenue by month, which many of you may not do normally. So the use of the financial statements, you're going to use it to get credit. You look at other people's financials to make investments. Banks are going to look at your financials to see if they're going to loan you money. The tax authorities look at them. Some of you larger companies may use it to determine bonuses and compensation. You may evaluate your competition if you're able to get your hands on their financial statements. And if you ever get involved in litigation, everyone's going to want to look at your financial statements. A lot of different business activities. Some of you are services. Some of you are manufacturing, some of you are retail. We have governmental, we have nonprofit. The type of business activity will have an influence on what financial statements you look at. The financial statements of a nonprofit or governmental unit look drastically different than those of a retail or a manufacturing business. So they're really going to be catered for your particular need. The basic ones we're going to talk about are the 4 basic financial statements: the balance sheet, the income statement, statement of cash flows, and we'll talk very briefly about the statement of retained earnings. The first 3 are the important ones that you should be looking at often. The balance sheet shows the relationship between assets and liabilities and equities at a particular point in time. It's basically a listing of everything you own and everything you owe at a particular point in time. The balance sheet, your December 31st, 2020 balance sheet, is literally a listing of your assets and liabilities at midnight on December 31st. It could be drastically different a month earlier. It could be drastically different a month later. But it's simply a point in time type of statement. The income statement is your report card, shows the success or failure of your companies during the period. Today, we'll be talking about annual financial statements, and we'll also talk about quarterly financial statements, because that's what you're going to need to apply for the PPP2 loans. You're going to have to look at 3 months of operations specifically. And the income statement summarizes all your revenue and all your expenses for the period. You can do monthly statements, quarterly statements, yearly statements, but they're over a period of time. If revenue exceeds expenses, you show net income. If expenses exceed revenue, you show a net loss. Okay, and this is really your report card for how you did during the period. It's going to be a 1 or 2 page statement that summarizes hundreds or thousands of transactions. Your sales transactions, your payroll transactions, your vendor transactions are all going to be summarized on the income statement. The retained earnings statement really shows your cumulative profit from your first day of business, less what you've taken out of the business in terms of distributions. It's simply an account on the balance sheet that shows what money you've made in the business and what money you've left in the business. And then the statement of cash flow statement describes what happened to cash during the year. Where did you get cash from? Where did your cash go out? Again, most of you think that cash comes in from sales, and that's correct, but it also comes in from investments. It comes in from loans, and it goes out for expenses, but it also goes out for loans. It goes out for investments that you're making. We also want to talk very briefly about generally accepted accounting principles. They're known as GAAP. When your accountant talks about GAAP, that's what we're talking about, that your financial statements, if we have to do them in accordance with GAAP, these are the commonly understood and accepted conventions for reporting on financial statements. Most of you will do your financial statements on the cash basis, which is basically your cash coming in and your cash going out. Most of your tax returns are filed on the cash basis. Some of the things we worry about when we talk about generally accepted accounting principles, we're worried about what we're going to value your assets at. We worry about when do we recognize your sales transactions? When is that sales complete? When should it be reported on your financial statement? And we worry about what should be disclosed in addition to the basic numbers. Accounting valuation is something that's debated all the time in the accounting world. And for the most part, we look at cost. We put the value, if you buy a car for $10,000, that's what it's going on your balance sheet for, $10,000. And that simplifies our job, that we don't have to worry about, we don't worry too much about fair market value at this point. Mostly what we worry about is what things cost. Recognition, how should it be treated? Should it be treated as an expense and we show it right on your income statement? Or do we show it as an asset and spread it out over 10 years? Something that's going to last more than a year, we generally treat as an asset and only expense part of it. We move part of it to your income statement every year through depreciation. And then we talked about disclosure a little bit earlier. We won't deal too much with that today. The form of organization, proprietorship, partnership, corporation, nonprofit, governmental, those are all going to determine what your financial statements look like. I don't have the ability to know who's out there today, but I suspect there are sole proprietors out there. There are partners out there today. There are corporate shareholders out there today, S Corps, C Corps, and all different types of organizations. There may even be some nonprofit and governmental people out there today too. And then the notes to the financial statements that you only see as a business owner if you have an outside CPA preparing financial statements for you. And these are typically, the financial statements might be 4 or 5 pages long, and the disclosures, which we'll talk briefly about later, might add 10 to 15 pages to your financial statements. What we do as CPAs, and some of you may have audits, that we come in and we give an opinion on your financial statements. We'd say that your financial statements are in accordance with GAAP. Some banks require audits. If you're a nonprofit organization with a certain amount of revenue, the Attorney General requires that you get audited every year. Only CPAs, only certified public accountants are allowed to provide audit services in Massachusetts. We have a specific license that let us do that. Some of the basic terms we'll talk about briefly that are important to us is we want the information to be relevant. We don't want to report on stuff that doesn't matter. We want it to be reliable, that the numbers you're looking at are free of material error and bias. We want it to be comparable from year to year. That's very important now. All of these grants and PPP2 loans are contingent upon your numbers being compared from one year to the next year, pre-COVID versus post-COVID. And that's what's going to determine whether you get some of these grants. And we want things to be consistent. Again, other things we worry about is time period. And we can break down time periods. Literally, you can produce an income statement by day if you wanted to. You could do weekly, quarterly. Like I say, for the most part today, we'll be talking about quarterly and annual income statements and financial statements. Going concern is, again, the assumption is that you're going to keep going. We're going to take your car and spread it out over 5 years because we expect you're going to be in business for 5 years. If we don't think that, we have to modify what we do. We talked about things being recorded at cost, and we also want everything that should be disclosed to be disclosed as part of your financial statements. A big concept we'll talk about briefly, but is important, is accrual basis is generally accepted accounting principles. Your revenues are recorded when they are earned, and your expenses are recorded when they are incurred, not when received or paid. If I sell you something this month, but I don't get the money till next month, on the accrual basis, I record that revenue this month. On the cash basis, I won't record that revenue until next month. Okay. If you want to have generally accepted accounting principle statements, you have to do it on the accrual basis. We recommend that you look at things on the accrual basis because that's the true picture of how you're doing. If you want to know if you're truly making money, you have to look at things on the accrual basis. Most people don't look at it on the accrual basis because they keep their books on the cash basis. They file their tax returns on the cash basis. Your personal tax return, you file on the cash basis. You report your payroll when you get paid. Okay. You report your charitable contributions when you make them. You report your interest to your bank when you write the check. That's the cash basis. And that's what most of our world is revolving around, the cash basis. The PPP2 loan talks about your gross receipts comparing between 2 quarters. What money did you receive from customers one quarter this year versus what money you received from customers the same quarter last year? That's going to determine the eligibility for your PPP2. And then tax basis is a whole new ballgame. That's really literally your tax return. Most banks, this is what they take. This is what they look at. They look at your tax return. They aren't requiring accrual-based statements. They aren't even requiring purely cash-based statements. They're looking at your tax return, and that's what they're basing a lot of their decisions on. And that could be very different than accrual basis, because the tax return has totally different rules than some of the accounting principles. So let's talk about the balance sheet. We talk about a classified balance sheet where we list things from how quickly they're going to turn over to the bottom of how long you're going to have them. We start with things like current assets, and we'll talk about each of these in turn. Long-term investments, property, plant, and equipment, or your transportation and business equipment. Other assets we'll talk about. Current liabilities, or what you owe people that you're going to be writing checks for in the near future. Long-term liabilities is what banks have loaned to you, and you're going to pay back over more than a year. And then the equity is the money that you have in the business, what you initially started with and what you've left in the business. Current assets are things like cash is the #1 current asset, but it's also going to include any short-term investments you have, your accounts receivable, what your customers owe you, your inventories, what you're holding for sale, and then prepaid expenses, some things that you have to pay that you've paid for in advance. Cash is easy. It's what you have in the bank. It's easy for us to verify it. It's easy to know what you have. Checking, money market accounts, anything like that. Some people have enough cash, okay, which is a nice position to be in, that they take money out of the bank and they put it into short-term investments. They might open up a Vanguard account or a Fidelity account, and they leave what some people would consider cash sitting there collecting interest. One problem with the short-term investments now is they're literally paying 0 interest. I've seen some short-term investments that are paying 0.1% interest or 0.2% interest. It's very low at this point because the interest rates have been held down so much. Inventories, again, are something that if you're selling a product, you're gonna have finished goods, raw materials. Some companies like us, service companies, have work in process. If I've done half of your tax return and I haven't billed you yet, theoretically, I have work in process that are costs that I haven't billed out yet. I haven't converted them to revenue yet. So they're considered an inventory for me. One big difference between the tax returns now allow some companies not to record their inventories, that you can expense your inventories as you go. All right. The problem with that is that's a poor indication of whether you're making money or not. It's a good way to file your taxes, but it's not a good way to run your business, not knowing what the inventory is. I think we skipped over a slide on accounts receivable. I don't know if I showed any more. Accounts receivable is the money that you've billed customers and they haven't paid you yet. Prepaid expenses, probably the typical one here is insurance policies. If you have to pay your insurance policy in advance, we'd list that on your balance sheet until the policy expires. So those are all examples of assets that may be on your balance sheet. There's accounts receivable. All right. And again, because all customers don't pay their bill, you may have issues with not all your receivables are good. Most banks, if they're looking at you, they're going to look at your aging of receivables, and any receivables over 90 days, they're not going to count as assets for your business. They're not going to let you borrow on those. They're going to be critical of you having receivables out over 90 days. So that's something else to watch. Non-current assets, the biggest non-current asset are property, plant, and equipment. Again, the vehicles you use in a business, your equipment, your office equipment, your computers, things like that are things that are going to appear on your balance sheet until you depreciate them. And then you depreciate them over time. And that's literally taking them off your balance sheet and transferring them to your income statement. And again, buildings, equipment, furniture, fixtures, anything that's used in the operating of your business. Intangible assets. Some of you may have these or may not, so we won't spend a lot of time on them. But there's no physical existence of these intangible assets. Those are things like if you're buying a franchise, if you've bought a trademark, if you've bought another company and you've paid more for the company than the assets might have been worth physically, you're going to recognize things like goodwill. All of these things are purchased from others. These are not things that you generate yourself. Then we get it on the other side of the balance sheet. So the assets is one side of the balance sheet. The other side of the balance sheet are the current liabilities and the equity. And we call it a balance sheet because the assets equal the current liabilities plus the equity. Okay, that's why it has to stay in balance. Every transaction your accounting books record, there's a debit and a credit, and they always equal. So we used to kid about the books not being in balance, okay? Your books have to stay in balance because there's equal amounts debited and equal amounts credited with everything you do in the accounting world. Some of the things you're going to record on accounts payable are any bills that you haven't paid yet. On the accrual basis of accounting, we put those bills into our income statement, even if we haven't paid them yet. And they sit here in accounts payable until we pay them. Short-term borrowings, many of you have lines of credit with the banks that are due basically when the bank wants them back. None of them are last longer than a year without getting renewed. And then things like dividends payable and unearned revenue that probably won't apply to most of your small businesses. Accounts payable, again, what you owe to suppliers for previously delivered. Sometimes referred to as trade payables. Sometimes you'd record as trade accounts payable. At this time, if there were 12 of you sitting around the room, I'd talk to you about how you're keeping your books. Are you keeping them on QuickBooks, which probably many of you do? A lot of people, they don't enter the bill until they write the check, okay? And that's really keeping everything on the cash basis. They have their bills sitting in a pile, and then they enter them into the computer when they're going to write a check. The way this system's supposed to work is that when you get a bill, you put it in the computer. You don't have to write the check that day. But on any given day, the computer will tell you, these are the 7 bills that I have that I haven't paid yet. Those add up to your accounts payable. The advantage of doing it that way is that it puts the expense in the right period. You don't sit on something for 2 months before you enter it. You enter it as soon as you get it, and then it's accounted for. And then all you have to do is pay the bill. And that way, QuickBooks will produce statements both accrual and cash basis if you put everything in when you're supposed to. So it's really a nice system to use. Accrued liabilities are amounts you don't know or you don't get a bill for. If you're paying your rent 15 days late, you'd put it into accrued liabilities and then take it out when you pay it. Again, this is something that would be detailed in the notes to your financial statements if you had a lot of accrued liabilities. We talked about short-term borrowings, dividends payable. If you're an S corporation, you may be recording dividends payable before you pay them to your shareholders. Unearned revenues are the opposite of prepaid expense. If you're billing someone in advance, if we bill someone in advance for 6 months of accounting services, we would initially put it in unearned revenues. And then once a month, we'd take out 1/6 of it and transfer it to our income statement. They give the example here of a magazine subscription. What might be a prepaid expense on your books is an unearned revenue liability on the books that you're buying the service from. Long-term liabilities, again, for big companies, we talk about warranties, employee benefit plans, leases, bonds payable, and long-term obligations. The ones you're going to be dealing with mostly are the long-term obligations. What do you owe to your bank? What do you owe to a friend that's loaned your company money? Leases or be the things that you've entered into long-term rent contracts for, all right? That those liabilities are now recorded on the books. When warranties, an example of warranties, when Ford sells you that new car, they record that entire sale on their books. But at the same time, they know they have to estimate how many times you'll be back in the next 5 years and making them repair your car for free. And they may say, so I sold that car for $35,000. I'm putting $1,000 worth of potential expense on my books from when I know that person's going to bring that car back for free repairs. And those are all things that are estimated. When we talked about accounting not being, an exact science, a lot of estimates go on here. But probably very few of you have an employee benefit plan. But if you ever work for a company, or if you ever buy stock in a company that has pension plans, they have to estimate what that pension liability is going to be. And they have to put that on their books. Some examples of the things we talked about: the warranties, the employee benefit plans liabilities, the leases. And think about a lease that you're going to enter into for 5, 6, 7 years. Okay, so that's a liability you're going to put on your books. That's a lot of payments that you've promised to make. And that promise is recorded on your financial statements. Bonds payable are things that big companies do. And again, you'd have long-term borrowings. The part of the loans that if you borrow money on 5, 7, 20 years for possibly a building, the entire amount is put on your balance sheet as a long-term debt. That is not money you have to pay back in the next year. And then stockholders' equity is basically the difference between assets and liabilities. It's the money that the owner has fronted the business or left in the business. When you started if you started a corporation, you issued stock. Maybe it was $100, maybe it was $1,000. That stays on your balance sheet forever. That's money that you committed to the business. And that's money that's theoretically owed to the stockholder. Some of the things we won't get into a lot of detail, are additional paid-in capital. Something that we're seeing more and more of are classes of common stock. As you have succession plans for your business, a lot of companies, this is getting very popular, that as they want their children to come into the business, they're issuing different classes of stock that may not have a voting right. So they can give 10% of the stock to their children, but their children don't have a say in the business. Some companies could give 90% of stock to their children. And if it's non-voting stock, the children still don't have any say in the business. They own 90% of the company theoretically, but they don't get to decide. The parents still maintain control of the direction of the company. And we're seeing more and more of that as businesses are passed from generation to generation. And then we talk about retained. And that's in a big company, this is millions, billions of dollars. It's money that the company has made that they haven't given out to their shareholders. Your entire net income goes into this every year. And then what you take out in terms of dividends or distributions comes out every year. This is equivalent to the capital account in a partnership or a sole proprietor. So when we look at the balance sheet, assets equal liabilities plus stockholders' equity. Remember, the accounting equation must always balance. This used to be an issue when we had paper general ledgers. But now with the advent of things like QuickBooks, the companies stay in balance much easier than they used to. Okay. So next we talk about the income statement. One of my biggest disappointments as an accountant is when I meet with a client in March and their first question to me is, how did I do? Okay. And I said, well, you should be telling me that, how you did. And a lot of people, they don't look at their income statement. When I tell them they made a certain amount of money, they're surprised. And especially when I tell them you lost a certain amount of money, they're surprised. You never want it to be that way. You should be able to tell me, I'm doing good, I'm not doing good, and this is why. So we want you to look at these income statements. Again, revenue, we talk about, and again, big companies have all sorts of issues about when they should recognize revenue and things like that. Someone selling a cell phone plan. We could have long debates about when revenue gets recognized. For most of you, Revenue is when you earn it. When it's legally due you is when it's revenue to you. And it's when you've sold the good or you've provided the service. You're also reasonably certain to collect the revenue. And again, the effect of the net income statement, we start with the beginning balance sheet. We have the income for the period, and we end with the ending balance sheet. All the profit from the period goes to that ending balance sheet until we decide how much of it we're going to distribute. The format of the income statement, we divide it in a couple different sections. If you're selling a product, the first section we try to determine is your gross margin. How much profit margin are you making on that thing you're selling? Okay. And then we subtract out other types of expenses, general administration, operating income, other income and taxes, and net income. And we want things to be comparable. We're concerned about the gross margin because we want to know that you have a chance to make a profit. You have to be charging enough for your product to produce a gross margin. Okay. Some companies that can be as high as 50 or 60%. And then you have to deduct all your other expenses to determine your bottom line. One of the biggest mistakes we see from small business is they're simply not charging enough for what they do. And they have no hope of making significant amount of money because they're not covering their cost of sales. They're not covering their gross margin. Some industries that could be as low as 1%. And if they have a high enough volume, they're making good money. But other industries, that margin needs to be 50, 60, 70% to cover all their other expenses. So it really depends on what industry you're in. I always talk a lot about, I want to define EBITDA to you, because a lot of people, when people talk about buying businesses and selling businesses, and you hear this term all the time, EBITDA, I want you to at least have a definition of what it is. And it's earnings before interest, taxes, depreciation, and amortization. Okay. And it's used, a lot of valuation methods will determine if you're in a certain industry, they'll say your company is worth 3 times EBITDA. For you to have a positive EBITDA, you have to have net income. Okay. You have to have income. You have to have profit. And that's going to help determine if you're selling your business. And again, not really relevant to financial statements, but it's important you know what that is. You hear that bantied about all the time. What's your EBITDA? So revenues we're talking about, and we're getting into that with the PPP2 loan. Revenues, sales, billings, all the same word. Okay. A lot of it's going to depend on what business you're in. All right. What you're charging for your product, what you're getting paid for your product. The PPP2 talks about gross receipts, which is your revenue if you're a cash basis business. Your receipts are your revenue. Other types of revenue, a bank is going to have interest revenue. Most of us don't have interest revenue because we don't have enough cash in the bank. And even if we had cash in the bank, they're not paying enough interest to cover fees. Other people have commission, asset management, portfolio service fees if you're managing other people's money. Insurance companies have premium revenue. It's still their sales. They're still their gross receipts. Gains and losses is another form of revenue, but we say we spike it out differently because this isn't what you're in the business for. You have a gain or loss when you do something other than what you do in your business. We have revenue when we do a tax return. We have gains and losses when we sell a car that we've used. Okay. It's not an ordinary part of the business. So we call it something a little bit different. We don't consider it revenue. And again, the income statement's your report card. Success or failure during the period of operations. When I worked at Friendly Ice Cream, everything was weekly financial statements. And the big comparison was the third week in July this year to the third week in July last year. That's what all the performance ratings were based on, weekly. Most of you are going to look at it hopefully monthly, but I know a lot of companies I do a quarterly review with, where I sit down with them every quarter and go through their income statement. And you're certainly going to do it on an annual basis. And again, the income statement summarizes all the revenue and all the expenses for a period of time, month, quarter, year. You can look at it daily if you want. And if revenue exceeds expenses, you have net income or profit. And if you don't, you have a loss. Then we talked about retained earnings before. Matching principle. And again, this is when we talk about GAAP accounting, generally accepted accounting principles, we want to show the expenses in the same period that the revenues they're related to. One of the things we have, and the big thing is on depreciation. The accountant takes an asset you buy, whether it's a building, a piece of equipment, or a car, and we put the cost of that asset on your balance sheet if it's $20,000. And then if we think that's going to last 4 years, we're going to take $5,000 away from that asset every year for 4 years and put $5,000 on the income statement as depreciation expense. So if you buy a $20,000 piece of equipment for the next 4 years, there's going to be $5,000 of depreciation expense on your income statement to show that that's when you're getting the benefit of that $20,000 piece of equipment. That piece of equipment is going to help you earn revenue over the next 4 or 5 years. We want to take the expense of that equipment and spread it over the next 4 or 5 years. That's why we have the concept of depreciation. That's what it is. Okay. We depreciate a building down to zero. Okay. If you buy a building over the next 20 years, we're going to bring that down to zero. Is that building worth zero at the end of 20 years? And the answer is no. It might be worth twice what you paid for. Okay. But we still want to show that cost of that building over those 20 years. So we bring it down to zero. That's one of the limitation of financial statements, is it doesn't necessarily show what your assets are worth. It shows what you paid for them. The IRS makes it harder because when do they let us depreciate things? How long do we have to spread things out for the depreciation of the IRS? For many things, including cars and equipment, we can spend up to hundreds of thousands of dollars on them, and we can expense that all in 1 year, okay? Which is great for the tax return, but it doesn't make for very accurate financial statements. So we want to talk about accounting conventions. When do we record these expenses? And again, we want to show them as we're earning the money that they prize. So we talk about a systematic depreciation is a systematic process of spreading the cost of that equipment over its useful life on the income statement. Different expense concepts. Again, this is what we're consuming when we earn revenue. It's payroll, it's utilities, it's cost of buildings, cost of equipment. We have cost of sales, we have rent expense. We talked about depreciation, all different classes, and we classify them that way on the income statement. You get into accounting scandals, people recording revenue before they've earned it. They don't show expenses before when they've expensed them, they put them off into later periods. And then we talk about money that we owe that we don't show on our balance sheet. I don't think we've had a good accounting scandal in the last year. You have to go back to the Arthur Anderson days and the WorldCom days, and Enron was a big one, okay, where they did all of these accounting errors, okay, and they falsified their financial statements. And that's why we have auditors to try to prevent that from happening. Common size financial statements are something that everybody can use, okay? A common size financial statement is when on your income statement, we take everything and move it down to percentages. If your sales are $100,000, we take all your expenses and we show them what percentage they are of sales. Okay. And that way we call them common size financial statements. Because that way, if you're a $100,000 business, you can compare yourself percentage wise to $1 million business. You'll know you're spending 7% on payroll. What's your competitor who's 10 times bigger than you? What are they spending on payroll? And you'd see that they're spending 6% on payroll or 8% on payroll. And you can use that to try to adjust what you're spending money on. How much do people spend on advertising? Things like that. And they do the same thing with the balance sheet. They convert everything to a percentage of total assets. And that just lets you compare over periods of time and also against competitors. And there's data sources available so you can compare yourself. If you're running a car wash, you can compare yourself with other car washes. A bakery, a restaurant can compare themselves with other bakeries and restaurants and not worry about how big they are. The retained earnings equity statement that we talk about, we look at stock issued, net income, dividends paid, and then some of the other things, unrealized gains and foreign currency translation, we really don't have to get into today. All right. Any questions on the income statement before we go to the cash flow? It's pretty straightforward. It's one of the most understood statements because almost everybody looks at that. Okay. But it's really, and most of you on the cash basis, it's a fairly simple to construct. You can construct it right out of your checkbook.
No questions in the income statement here, Rob.
Okay. So let's talk about the cash flow statement. The cash flow statement is probably one of the most important statements that many, many small business owners never, ever, ever see a cash flow statement. The only time they'll see it is if the bank requires formal financial statements. And if the bank requires formal financial statements, the accountant has to prepare a cash flow statement because it's a required statement. And the purpose of the cash flow statement is to show the income statement from an accrual basis to a cash basis. So many of you that are keeping your books on a cash basis know that. But if you're keeping your books on the accrual basis, it really explains you made $100,000. Why isn't your checkbook $100,000 higher than it was last year? Okay. And there's 100 reasons that may not be the case. Okay. The cash flow statement literally explains those 100 reasons. QuickBooks will produce a cash flow statement in 30 seconds. It'll do it. It has the capability. And again, why focus on cash? Because your investors, your bankers, other interested parties want to know what's happening to cash. Cash is literally the lifeblood of your business. So it's important to keep a handle on cash. And again, some of the things that it explains. Why did your cash go up and you had a net loss? Is cash flow greater or less than net income? How was the expansion in plant and property equipment financed? Was it paid for with cash or was it paid for with bank debt? The cash flow statement will show all that. How much debt was paid off? The cash flow statement will show that. How much money was borrowed? The cash flow will say that. Think about the balance sheet. The balance sheet shows debt at the beginning of the year and debt at the end of the year. It doesn't show how much you borrowed, doesn't show how much you paid back. All it shows was the balance at January 1st and the balance at December 31st. The cash flow statement might show that you borrowed $1 million and pay back $1 million. Your debt could have been $100,000 at each period, all right? But you might have moved $1 million worth of cash through that debt account that year. The cash flow statement would show that. That's why it's important. And it wouldn't appear on your balance sheet. And again, it provides information about cash receipts, cash payments, and then we break it up into 3 parts: operating, investing, and financing. Those are the 3 main sections of the cash flow statement. In the operating activities, it's really your operations, what you're getting in from your customers, what you're paying for inventory, what you're paying for services, what you pay what you're paying the government for taxes, how much you paid to your bank for interest, really your operations, what you do over the ordinary course of business. The investing section talks about what did we invest money in other than people, but what did we invest money in for fixed assets? And talks about buying property, plant, and equipment. It also talks about selling property, plant, and equipment. Again, the balance sheet only shows the balances at year end. This shows what happened to those accounts during the year. Where did you use your cash for? Quite often we'll meet with a business owner who knows he's making a lot of money, but he doesn't have any cash. And one of the reasons he doesn't have any cash is that he built that new greenhouse or he bought that new tractor. Okay. That doesn't show up in the income statement, but it shows up in the cash flow statement as this is what I did. This is what I did with the money. And then financing activities. How do you finance your business? 2 principal purposes, yourself and outside bankers. Okay. And this is going to show what you invested in the company for the year, what you paid back to yourself for the company for the year, and what bankers gave you and what you gave bankers back. Again, not just the ending balances, but what affected those accounts during the year. And this literally starts with net income at the top and ends with increase or decrease in cash at the bottom. A typical cash flow statement might have 30 lines on it that show the difference between net income and your cash balance. And it can be affected by that many things. So that's why the cash flow statement is good to look at, especially if you're keeping your books on an accrual basis. The notes are things that anytime you're evaluating your company, it's important to look at these notes to the financial statements. You know, they talk about, and again, any of you that are involved in nonprofits, your company is certainly producing full financial statements with disclosures because they have to report that to the Attorney General every year. You know, we talk about the nature of business. We talk about how you're keeping your books. We're talking about your receivable policies. How do you cost your inventory? More and more property and equipment. What are your policies for what you expense? Advertising is a required disclosure that you have to tell people what you're spending on advertising. You have to talk about credit risks. If you could have 2 million in sales, but if you only have 2 customers, that doesn't show on your income statement. Your income statement says you have 2 million in sales. But if you're evaluating this company, you're going to want to know if those 2 million in sales are from 2 companies, not 300 companies, but 2 companies. You're going to want to know that if you're evaluating that company. So this is where it would be disclosed in the footnotes. It would say that 80% of our sales are coming from 2 companies. And you would view that as a riskier company. If you're offering anybody credit, you should be looking at their financial statements before you say, I'm going to loan you, I'm going to let you pay me over time. You should be looking at these things. On the balance sheet, inventory will show as one number. In the notes, it's going to say how much of it's raw material, how much of it's work in process, how much of it is finished goods. It's going to give you much more detail. On investments, one number on the balance sheet. In here, it's going to say what type. Is it mutual funds? Is it stocks? What's the cost? What's the fair market value? When's it due? Things like that. Much more detail than the notes. Related party transactions, which are big in the nonprofit world. But if you're selling, again, you have that 2 million in sales and 1 million of it is to a company that your brother-in-law owns, okay? That doesn't show up on the income statement, okay? But it would show up in the footnotes. It would show up and say, half of my sales are to a related party, okay? And that's something you want to know if you're doing business with a company. If there's accrued expenses, it would give more detail on that. Long-term debt, balance sheet, one number. I owe $1.2 million to banks. In the footnotes, it would list every note you have. Okay, if you have 5 different note instruments, it would list all 5 of those. It would say what the interest rate is, what the collateral is, when are the payments due, how much are the monthly payments. It would show all of that. Okay, commitments and contingencies. One thing we've had to add to every footnote, every financial statement that we produce, and we produce a lot of financial statements, we had to produce a COVID footnote. And what does that COVID footnote say? We don't know what's going on and we don't know what's going to happen. Okay. It says that in legalese. Okay. Is that there's a lot of uncertainty. Okay. About these businesses. The businesses have survived to this point, but we're operating in very difficult times. You have to be aware of that. We put that in the footnotes. Any benefit plans, and again, fewer and fewer companies have true pension plans, but we do have some law offices, doctor's offices that have complete benefit plans. There might be 3 or 4 pages of footnotes talking about everything involved in those pension plans. We talk about income taxes. We won't talk too much about asset impairment. That's a big business thing to worry about. We also put a lot of the loans you sign have what are known as covenants or restrictions on what you can do. The SBA, a lot of their loans have some fairly restricted covenants on those. They may say you can't give your president a raise. They could say you can't spend the money on this or can't spend the money on that. You have to keep certain ratios. And as an accountant, we have to go in and make sure that you're meeting all those covenants. And that has to be put into financial statements, whether you are or you're not meeting those covenants. And again, some of the negative covenants they talk, the bank may say you can't do a dividend until we're paid back. They may say that these money, and the SBA is big on this, that if you're borrowing money from the SBA, you know, this is what you're saying you're spending the money on. That's what you're supposed to spend the money on. And again, they may require to keep certain ratios. Again, we always talk about looking at the long view, looking at multiple years, revenue consistency, earning trends, capital expenditures. Another beautiful thing about QuickBooks is if you've maintained QuickBooks for 6 years, you can run 6 years worth of income statements on the same page, and you can look at all those trends. Okay, you can transfer all that data into Excel. You can produce all the charts and graphs you want. So it's very, very handy, especially if you're using it for multiple years. When we, what do people look at when they look at the balance sheet? Again, they're looking at, you know, can you afford more debt? A lot of banks are worried about that now, especially with the uncertainty that's going in. They want to know if your inventory is too high, is your receivables growing? Those are all things that they can evaluate on the balance sheet. Some of the income statement, again, we're going to look at that gross margin, the operating margin. We want to look at cost trends. Is your payroll, what percentage payroll is of sales? Is that going up or going down? Normally, we want to see that go down. Payroll is one of the most expensive things you have on your books. We want to see if you're producing, your employees are producing enough sales. We always look at sales trends or sales, which direction are sales going? For the most part, they've been going down because of COVID. Interest coverage is your ability to pay more interest. All right. You have to make enough money to not only pay your loan back, but also pay the interest. This has become a different case because interest rates are so low right now. You know, historical perspective, I tell people I bought my house in the, when did I buy my house? In the 80s. My first mortgage was 19%. Okay. And now if you get a mortgage now, it's 1%. And people don't, you know, 2%. People don't believe, you know, that mortgages were ever that high. And so interest coverage gets looked at differently depending on what the interest rates are in any given period. We talk about working capital, you know, and that we want to look at your ability to pay liabilities. When we talked about the balance sheet, we talked about current assets and current liabilities. Okay. And that's what's called working capital. We want your current assets to be more than your current liabilities. If your current liabilities are more than your current assets, that forecasts that you're going to have trouble with cash flow. And that's why banks look at that so much. And we talk about the current ratio. A lot of banks, this is a covenant that they take your current assets and divide by current liabilities, and it has to be a certain amount. It has to be over 1. A lot of banks say it has to be 1.2. And that's something you can look at when you look at your comparative financial statements. Okay. And those are restrictions that banks can put on your financial statements. Receivables turnover is your receivables getting too high? They should, you know, ideally, if people are paying you in 30 days, your receivables should be 1/12 of sales. Okay. So your receivable turnover ratio should be 12. Okay. If it's more than that, they're going to say, good, you're turning your sales over quick. We're going to do the same thing with inventory. We can look at oh, I don't have that slide. We can look at inventory turnover. And those are all things that we can look at.
Okay. All right. So let's take a quick pause here. We have 3 questions. When a loan is received, does it all count as income?
No, it does not count as income. The loan coming in won't even go on the income statement. The loan goes on the balance sheet. Your cash would increase by, say it's a $100,000 loan. Your cash would increase by $100,000. And on the other side of the balance sheet, your loan account would increase by $100,000. Doesn't affect the income statement at all. It's not income. It stays on the balance sheet.
All right. For the PPP loan, is that based on cash or accruals?
It's going to be based on cash receipts. Okay. So the loan amount's going to be based on 2.5 times your payroll, which is cash gone out. You can take the average of your payroll in 2020 or the average of your payroll in 2019, and 2.5 months of that will determine how much money you can borrow under the PPP2. Whether you're eligible or not, they're going to look at 3 months worth of receipts, either the first quarter, second quarter, third quarter, or fourth quarter of 2020 versus 2019. And your revenue has to have gone down in that quarter by 25%. Now, for most people, that's going to be the second quarter from April through June of 2020. If you operated a typical business and if you were shut down, your revenue certainly went down by 25%. We're seeing some interesting things like dental offices were shut down during that quarter. So every dental office in the free world qualifies for PPP2. A lot of dental offices, if you look at the course of their entire 2020, their revenue didn't go down because once they reopened, they were working overtime to get their revenue. We have some businesses that were involved in some restaurants went down in the second quarter. And believe it or not, some restaurants had more sales last year than they've had before because they catered very much to the takeout crowd and they were able to do a good job with the takeout crowd. So even though their revenue is up for the year, because they were shut down during that second quarter, they're eligible for the PPP2 loan.
Right. And so that all relates to the second draw if you had a PPP loan
Yes.
already. But what about for those who are applying for the PPP for the first time?
Well, there's no revenue requirement for the PPP for the first time. You have to say a statement that you've been affected. Okay. Mm-hmm. Our business got a PPP loan because we were certainly affected by it. Our revenue dipped in the second quarter because businesses were shut down. They didn't pay us. Okay. But our revenue was up after that. So and basically, you just have to answer a statement saying that you're affected by COVID. And everybody has been affected by COVID.
Right. And there is a particular industry that could apply for up to 3.5 times.
Yeah, I believe that's mostly the restaurant.
Yeah, I think next code starting with 72.
Right,
I believe that's
and they can apply for 3.5 times payroll. Yes,
yes.
The pre-COVID payroll if they want. Yeah, yeah.
Correct.
Yeah.
Correct. All right. And where do you put the PPP, given that it will convert to a grant, but it is given as a loan? Yeah,
believe me, we've been dealing with that big time in the office. That we've put it on the balance sheet, okay, with a footnote, with a page of an explanation in the footnotes to the financial statements, because theoretically it's a loan until it's forgiven, and we're just starting now. People are getting the forgiveness. There wasn't a big hurry to do it. They've changed standards a couple times where now up to 150,000 is supposed to be the easy forgiveness. So we're seeing right now a rush of people to get it forgiven. So they show it on the balance sheet until it's forgiven.
Right. And here's a question from one of the viewers. We launched our e-commerce home decor store same year that COVID occurred. We do not have revenue, didn't get a chance. What are your suggestions?
I think there's provisions for that. If you didn't have revenue the year before, I think you're eligible to apply.
I believe it's February 15th, 2020.
Yeah, as long as you started by then. I think that's something to talk to your banker about, and they'd be able to shepherd you through that.
And you would use your financial statements to prove that you were in business before February 15th, 2020.
Yeah. An advantage of QuickBooks, and again, I don't want to spend, I don't want to sound like I'm selling QuickBooks because I'm not, but QuickBooks produces these statements, any of these reports that you need. You can run your income statement quarter to quarter comparison, cash basis, accrual basis, all these things. So it's very handy for applying for a lot of these grants. One of the grants we'll talk about, you need to break it down by month. Okay. And QuickBooks will do that. On one page, they'll give you your month by month revenue.
Right. And in this particular case, if they did not get to have any revenue, there's other ways to prove they were already in business showing the lease. probably,
Yep.
showing that they had a
Yeah.
lease, their
Yeah. And
business
your bank would know
certificate.
that. 'Cause your bank would be helpful on that because they'd see what's going through your operating accounts. So they'd be able to establish a clear start date.
Right. We have a question here, a quick question. How is goodwill written off?
Goodwill is rare. Okay. Because like I said, the only way it comes up is if you buy a company. Okay. That's when goodwill is recorded and it's written off. Okay. On a tax basis, the IRS lets you write it off over 15 years. On an accounting basis, on a GAAP, generally accepted accounting basis, you're only supposed to write it off when it's gone. Okay. So you're supposed to evaluate every year if you have goodwill. And if it's less than a year before, you can write it off. If it's not, it's very subjective. But the taxing authority lets you write it off over 15 years, whether it's there or not.
Right. And I'm answering the question in Q&A here. The 25% decrease in revenues does not, I'm answering it. It does not apply to first-time borrowers, only to the second-time borrowers.
Right. The
So,
PPP too. Yep.
right. Correct. And when a loan is forgiven, do you, I'm not sure I said, do you doctor the loan payable and credit other income since, do you
Yes.
debit? Okay.
Yes.
When a loan
Yeah.
is forgiven, do you debit the loan payable and credit other income since the expenses were reflected the year before?
Yeah. Yes. Yeah. You'd record it as other income when it's forgivable. And then the tax treatment on that has been clarified. Okay. That these PPP loans were never going to be taxable because the Congress said that it was tax-free income. But the IRS came out and said, that's well and good. You're not going to be able to deduct your expenses. Congress went back to the IRS and said, no, you can deduct your expenses. You don't have to record the income and you can still deduct your expenses. So the PPP for 1 loan and a 2 loan are totally tax-free grants to you. Okay, that there's no tax implications at all on those. We could have a whole afternoon class on the state. Okay, because the state, if you're a corporation, you can deduct those expenses. If you're an S corporation, a partnership, or sole proprietor, you cannot deduct those expenses. So you're in effect going to pay state tax on the amount of your PPP loan if you're one of those types of entities. But that's something you got to go through with your tax provider. I work at an office of tax providers and we've been tearing our hair out, okay, about, how this is going to be accounted for. And different states have different rules. But on your IRS returns, no income, full deduction.
Right.
Which is good.
So here's a bit of a longer question, but I think a lot of people are in the similar situation. Maybe, hopefully not, but maybe. Our CPA didn't file all of our income, even though we submitted all our invoices to them. They only submitted our 1099s, but not international income. This discrepancy between our profit and losses worksheet and our taxes was pointed out when our application was reviewed for a grant. We need to amend our tax return for 2019 and make this right. Where should we turn if we're confident on our CPA?
Well, okay. You should find another CPA. I guess that sounds scary to me that you didn't report all your income. So that's all I can say about that is you really need to reach out and there are a lot of very good tax preparers in the area. We're certainly consider ourselves one of them, but there are hundreds of very competent tax preparers in the area that can help you out with all this stuff. We've been busy all year helping people with grants and PPP loans and SBA issues and things like that. So most CPAs are up to speed.
Another CPA would be willing to take their case and help them amend.
Yep. Okay. Yep. Amending a return is not a big deal. Okay. Although you may owe some money. That's the problem. Yeah. That's what worries me about getting the income right. Yep.
Right. Another question here. I have a full-time job besides my business. The income limit for loan does it cover the income from business or the income from the full-time job and business together?
No, it would only be, so your full-time job is with another employer. So if you're applying for a PPP loan for your business, it would just be your business numbers would be involved because your payroll is from somebody else.
Okay. And a few more questions here. But for the quarterly reporting for eligibility, do I take accruals or cash reports?
They report it, they're saying it's cash receipts, okay, is how they define it. And you probably filing your tax return on cash basis. And they also mention it should be done how you file your tax return. And if you're a business like ours, those can be drastically different numbers, cash receipts versus accrual. So, yeah, but I think the cash receipts would get you there because chances are everybody's cash receipts went down in the second quarter. We were fully up and running. Our cash receipts went down 20% in the second quarter of last year. They didn't go down 35%, so we're not eligible, but our cash receipts went down substantially, even though we didn't skip a beat during all of this. We half our people started working from home, but we kept full employment, full busyness right through today. We're not looking forward to this tax season. We think it's going to be a rugged tax season.
Right. And when we talked about the forgiveness application for PPP loans under 150,000,
yeah,
that's not, you have to submit that to the bank, of course, but it's,
right.
the bank then, deals with the SBA in forgiving that loan for you. That's a separate application that you have to fill out. It's supposed to be an easy form. And
yes.
So that's available through all across the board because it's from, it's an SBA form.
Some banks,
any bank.
Some banks are and this is where we're starting to get upset, okay? Because some banks are asking for a lot of things that they don't need to grant forgiveness. Theoretically, under the new SBA guidelines, all the bank has to do is have you fill out that form and you're verifying that you spent the money on the proper things. Some banks are still asking for W-2s and payroll records and things like that. They're not really supposed to have to ask for that for under 150. They can come back later and audit you, okay, and ask for that. And the SBA is just rubber stamping. If your bank approves it, the SBA is going to approve it. That's guaranteed. Right. So, yeah.
And folks should know that they should keep their documents for 4 to 6 years.
Yeah, it's like anything. Your payroll record you should be keeping for at least 4 years, and 6 years is a better rule.
Correct. What are the documents that can be used to verify the 25% COVID loss?
I think it could go down to your bank statement. 3 months worth of bank statements each year is just the deposits, as long as that's what your revenue is. If you're using QuickBooks, you can run a report. You can run a P&L for second quarter this year versus second quarter the year before, and that'll document it.
Right.
Some banks have a spreadsheet that they're making you fill out.
Right. And so it's good. That's why I wanted to say that it's really good what we're doing here today with going through the financials, so folks know where to get the numbers for those applications.
Right.
How often are PPP loans converted into grant funding?
Well, as soon as you spend the money, you can apply for forgiveness, and that's when it's converted into grant. Yeah, and they expect the overwhelming majority of these to become grants.
Mm-hmm.
Yep. The banks don't want to service these as loans. They want to give you this money.
Right. And someone here received the PPP loan as a 1099 contractor. Now, can they apply for the PPP too?
Yes. They'll have to show the revenue loss. Yep.
Right.
Yep.
And does anyone who got first a PPP is eligible for the second PPP?
Yes.
They have to show that 25%.
Yep. As long as you show the 25%. Yep.
Okay.
They anticipate that most of the PPT2s are going to be people that have already had the PPP. The application's a one-page application. The only number you have to provide. Some banks are using what you qualified for last time. So they're assuming it's 2.5 months of your 2019 payroll, and you just have to give them the numbers for the quarterly reduction. And that's it. Mm-hmm. That's all is on the application.
How are you feeling, Rob? Should we continue? We still have maybe 7 more questions. Should we?
We should probably cover the questions, don't you think?
Let's do the questions.
Yep.
Oh, by the way, the person who you recommended to go see another CPA, they said they're going to be in touch with you.
Okay. All right.
Just so you know.
Yeah.
So if you have had people volunteer their time during COVID, how does that affect your income?
Say that again.
So this person is asking if you had people volunteer their time during COVID, volunteer time probably to work in your business.
Yeah.
How does that affect your income?
Well, it doesn't affect your income if they're volunteering because it won't affect your expenses.
Right,
Yeah. Yep.
right. And in computing receipts, does the first PPP money count in that quarter as a receipt? In
No.
comparing receipts, I think it's
No.
in comparing. There was a
Right.
little typo
No.
in the thing.
No.
Compare.
No, that you don't have to include that you in the 25% test calculation. Right. Yep.
Okay. From the sample from a 501c3 nonprofit, they received the first PPP loan. How do they determine or prove that the 25% or more loss when their income budget is always an estimation?
I guess I'd have to understand what their income was because I mean 501c3s have revenue just like everybody else, and it may be contributions, it may be grants. A lot of 501c3s might qualify because of the second quarter. We're finding that a lot of 501c3s got plenty of revenue after that second quarter because they got a lot of grants from the federal government, from the state government, but they still may qualify if their contributions dropped out during that second quarter. That's what's the beauty of you pick the quarter. Your revenue could be up in 3 of the 4 quarters. As long as it was down by 25% in one of those 4 quarters, you're eligible.
Right,
Even the first quarter, before COVID, if you were down 25%, you're eligible to apply.
And would sales tax filing suffice to document COVID loss?
I would think so, yes. If all your sales are taxable. Yep.
Mm-hmm. And is the PPP or EIDL there to replace unemployment?
You know, the PPP started off as replacing unemployment. That was the intent of the PPP, is that you were supposed to keep everybody on the payroll for 8 weeks and pay them. And then after the end of 8 weeks, we're all going to be able to take off our masks and go back to work. Okay. That obviously didn't happen. The other thing that happened that threw a big monkey wrench in the books was the $600 supplemental unemployment that the federal government applied. Okay. Is that many employees figured out that they were better off not going to work and not getting paid, that they'd be better off on unemployment because they did it with part-time. That's what happened to restaurants. My wife has a retail business where she has people making $200 or $300 a week. If they were unemployed, they were able to get the $100 a week from the state of Massachusetts and $600 extra from the federal government. So they were bringing home $700 a week on unemployment. They did not want to stay on the payroll for the PPP loan. So the PPP loan the whole program got blown up, and that a lot of people who got the money weren't going to be able to spend it in the 8 weeks because they stopped paying employees because they went on unemployment. So that's when they extended it to the 24 weeks, okay, that you could use payroll over 20-week period to earn your forgiveness. And that's what the second loan is set up that way as well. It's acknowledging the fact that, there are people that didn't come back to work and won't come back to work.
Right. Another question here. How does the process of applying for grants work in the startup phase? If you don't have a business financials yet, will numbers be based on your own personal earnings and financials?
Usually it might be set up on a business plan, and that's really up to the grant providers. I think most of the grants are going to well-established businesses. That's what I'm seeing anyway. I don't know, Sam, if you could comment on it. Are there grants really available for startups?
I want to say generally no. You can, in some instances, apply for a loan from like your local CDFI, which we have here at Common Capital, and there's other programs that you can apply nationally, Action USA, that do accept applications from startups for loans. There are crowdfunding ways of getting funding and investors. That's in your own money, in your home equity loan, et cetera, et cetera. There's all these different ways of financing your startup. But if you're pre-revenue, it's very difficult to get those. And typically grants are reserved mostly for nonprofits most of the time.
And the state ones went out to primarily veteran and minority businesses the first round. We had a number of clients get 75,000 grants from the state. One of them is going to have to give it back because they're not open. They're not going to open up again until there's a vaccine there, so they can't even take the grant. So that'll go to somebody else.
Right. And can the new PPP loan be used to pay 1099 contract workers?
No, they're not one of the eligible spending. That's similar to the first one. Yeah,
Right.
Only employees. But they've expanded, so 60% of it has to be paid on payroll. I'll put in a plug for me. Accounting fees now count towards reimbursement. So we must have had a good lobby for Congress on that. So it's the typical employee costs have to be 60% of it, but then also utilities, rent, mortgage. They've added outside accounting fees, and they've added human resource fees if you're using a contractor for human resource. So I should say some contractors are eligible, but it's very, very limited professions to who they're allowing in the calculation.
Right. And we had a question in the chat, and I apologize, Karen, I misunderstood your question. She asked if her business was incorporated August 21st, 2020. Were there any COVID-related resources available? And unfortunately, the state grant requires that you have to be in business by June 30th, 2019. And then the Valley CDC grants, I believe, is January 1st, 2019. So I apologize. I thought I saw it was 2019, but you said it's 2020. I'm not aware of any grants at this time available for businesses that have been incorporated after 2020. If you had a 2019 tax returns and you incorporated in 2020, you would, I guess, depending on when you started, you would be eligible. But
Right.
that, so.
And the PPP is February 15th of 2020. You have to be
correct.
In
and if she started in August 21st, she still
Yeah.
wouldn't be eligible for that.
You get credit for bravery, but not for, not any grants.
Yeah. Does the receipt of the first round PPP money count as receipts when figuring out the 25%
No.
for the second round?
No.
Okay. All right. And then here, I received an early first round PPP and have applied for forgiveness a few weeks ago due to some changes in the owner compensation rules and the fact that they are seasonal businesses, that they are a seasonal business. We were unable to get the full amount forgiven for the 8 or 24-week period. Will this disqualify us for a second draw?
No, but I take it. Yeah, I'd be curious to see what didn't get forgiven. But I understand the owner compensation rules may be a big part of that. But yeah, that doesn't stop you from because you don't even have to have your first one forgiven before you get the second one. It's not linked to that at all.
Okay. It says that 1099 employees are not forgivable in the PPP. I'm not sure what they mean to that.
Right, because they're not employees.
Correct.
Yeah,
and I am a
yeah.
And so this person is a sole proprietor and only paid themselves with a loan. Does this mean it's also not forgivable for what I paid for myself?
No, it is forgivable up to the $100,000 annual level. So it's like we figured it out. It's like $19.23 a week is forgivable for a partner or a sole proprietor or things like that. Yes.
So I think the confusion is here too. Like if you're a sole proprietor, right, and you own your own consulting firm.
Yeah.
But people pay you with a 1099, obviously. They pay you, you charge people, you invoice them, and they give you 1099 for what they paid you for the year.
Yeah.
But you yourself, you have a business that's, sole proprietor, or you might be an LLC, what have you. You qualify for the PPP, and there's calculations to determine how much you could get if you are, and then if you're using the monies to pay yourself, technically you're as a business, you're paying yourself for payroll purposes.
But if you pay some people as employees and other people as contractors, the contractors you pay aren't part of the formula for forgiveness.
Right.
You can be a contractor and you're part of it. You can get paid.
Right.
Yeah.
Besides a restaurant, would someone like a massage service or a hairdresser qualify for the 3.5 times expenses.
I'd have to look at the code for that. I don't think so. I think that was really aimed towards the
I think
food
it's
service.
restaurants, maybe catering, maybe
Yes,
something
yeah,
like that.
yeah.
Like it's related to food services.
Yeah, part of the new tax act that they passed is that prior to this 2021, companies could only deduct 50% of their meals they buy in restaurants. We can now, if we take someone out to eat now, we can deduct 100% this
Yeah.
year. That was something else that they did to encourage people to go to restaurants.
Actually, I have the terminology here, 3.5 times for accommodation and food services sector businesses. So accommodations, meaning
I think
hotels.
hotels. Yep.
Yeah, hotels, correct.
Yep.
As a new business that started after February 2020, would being such a new company make my company ineligible to apply for PPP loan assistance? The answer is yes, unfortunately.
Yes. Yeah.
Is
No,
the
like I said,
EID
that is.
Yes. Is the EIDL grant still open?
I think there's still, the EIDL program is open all the time. The emergency grants that they gave out for $10,000, up to $10,000, I don't believe that's open at this time.
That's correct.
The other
So,
unique
yeah,
thing they did was they initially said that that amount that you got for the EIDL grant couldn't be forgiven for the PPP loans because you got both, but that's now not the case. That with the law they passed in December, everything's forgiven. The entire PPP loan and the entire EIDL grant are all forgiven.
right. And it's retroactive. So if some of you
Yes.
got forgiven for
Right.
a portion of your PPP, but they did not forgive what you have received from your EIDL loan
EIDL,
advance,
now they're all
the
forgiven.
banks are now going back and sort of
Yeah.
taking that off your loan.
Yeah, that was
And
a
they
major
should.
thing, especially for small businesses that got
Yes.
a $20,000 PPP and a $10,000 EIDL. They were going to have to pay back 10,000 of the PPP, and now they get to keep it all. So that was very important for smaller businesses.
Right. And so just to answer that question clearly, the loan advance that was a grant is no longer available. The EIDL program loan is still open.
Yeah, we have a number of businesses that have gotten fairly substantial loans under the EIDL loan program from the SBA, and those have very, very favorable terms. It's restrictive what you can spend the money on, but they give you a long time to pay it back at a very low interest rate.
So someone asked here, what if you didn't get an EIDL advance? Is there a way to get some of the EIDL loan received forgiven?
No, not that I'm aware of.
No. And then we get another question here. I am a 1099 contractor and online business. Do I qualify? I think we're going back to the same question. So this person, if you are a
Sole proprietor.
you own your own business, sole
Yeah.
proprietor, yes, you would qualify. But if you are just kind of working for other people, doing sort of side jobs, I guess not.
No, I think if you file a Schedule C on your 1040 tax return, okay, I think you're eligible.
Right. And the reason why I bring that up too is some people don't make enough to file a Schedule C.
Yeah.
Like they do side jobs, but they don't make enough. They didn't file taxes.
We
But if
saw
you
a lot
file
of,
it-
yeah, we saw a lot of real estate agents and people like that get PPP loans. They also
Correct.
got unemployment for the first time. Some
Right.
Schedule C people got, which was never happened before, but they made them eligible for unemployment. So
Right. Pandemic unemployment assistance would be
Right.
something those folks would definitely want to look at.
Yep.
If you don't pay yourself for working at your business full time because you don't have the funds, can you use the PPP loan to pay yourself along with the other employees?
you can up to that limitation. They really opened it up. They allowed PPP COVID bonuses to be paid, to be added to employees' pay. We were able to include our regular tax season bonuses as forgivable. You're just limited by that 1923 a week.
Right. Are there any loans or grants available for students involved with small business?
I would say yes. You might be able to answer that better than I can, Sam, but certainly the SBA would have. There's a lot of loan programs.
For students involved with small business? I'm not sure I
If
understand
they're
the
working,
question.
again, if they have a business,
Oh,
if they have a business working with small business, yes. not just loans for going to school. You'd have to have a
Right.
business that you're charging
You
money.
have to have a business.
Yeah, you have
you
to
know.
have income. Yep.
Income. All right. And someone here took out a 3.75 SBA EIDL last year, not knowing about the second round of PPP. Can she still apply for the second round of PPP loans to have it if forgiven?
Yes. The second round of PPP would be forgivable. They got an EIDL loan. That doesn't that doesn't preclude them from applying for the PPP too.
What quarters do you compare to determine the 25 decrease?
So they're calendar quarters. They did specify that. So you have January through March, April through June, July through September, and October through December. Compare the 3-month period from 2020 to 2019.
Right. And can you use the PPP to create jobs?
I suppose you could, but the amount is based upon past payroll. So you could certainly.
I've heard it that you definitely use it to replace someone that left.
Right. Yeah. And if you use the actual cash to create, I'm sure that's, yeah, you can.
Yeah, it's payroll. Payroll is payroll.
Payroll. And payroll is forgivable.
Right. Rob, what if past payroll has dropped drastically due to employees resigning comparing to quarter 2 2019 to quarter 2 2020? How will the PPP loan amount be calculated?
You pick the period. On this average monthly payroll, is that shown on the screen now?
Yes, I can see the application, correct.
So you have to put in the average monthly payroll. You can use 2019 payroll. Some banks I've already heard is that if you're applying through the same bank, they're putting the amount in there that you applied for with the first loan. So they're assuming that your payroll went down in 2020. So that you can use your 2019 payroll for that. So the drop in 2020 has no impact on how much the loan can be. You just got to make sure you're going to spend that money over the 24-week period. Okay. And like I said, I know Westfield Bank is putting an amount in there based upon your first loan application. And they're using the higher number, the 2019 number. So that takes care of that you don't have to worry about how much they've come down.
Okay.
All right. And so that's the one line you have to fill out. And then the other line is the number of employees, the average monthly payroll, the number of employees. And then down here is where you put the gross receipts quarter to quarter. Some banks are giving you a spreadsheet to attach to this. And then, like I said, these are the covered expenses. For the most part, I think people are just checking payroll costs. But again, it can cover all of these items when you go for forgiveness, that only 60% of it has to be payroll related. And they've expanded what it can be used for in the PPP 2 application. So that's all good. That only 60% of it has to be used on payroll. And then the questions are just, you have to list the owner name. And then the questions are just the standard questions, have you killed somebody in the last 5 years? The standard SBA questions. All right. So it should be very simple. And especially if your bank is set up, okay, which I think most will be, they may be able to give you almost a pre-filled out application. And all you'll be doing is the gross receipts number. And like I said, if you're using QuickBooks will do that for you. You can run a report, okay, that'll show you what those numbers are. And like I said, we've seen people, their first quarter qualified, their second quarter qualified. Some people didn't qualify in the second quarter, but they did in the fourth quarter last year. So there's also, and it's any quarter. You pick the quarter. Your sales could be up all 3 quarters and down by 25% in 1 quarter, and you got it. So that's all good. So that application process should be fairly simple for those of you that went through the first one. Most banks are using outside vendors, and they're using the same outside vendor as the first time. So a lot of that information should be there for you. Some banks, People's Bank and Florence Bank, I think, sent people to Cabbage initially last time. And early indications are they are not doing that this time, is that they're doing it themselves, because that was a painful process. Any of you who went through cabbage, that was very difficult in the April, May, June time period. And I think those banks are now doing it themselves to make it more personable, more directly connected to them. Any questions on this application?
So I just saw a question coming. So if it's not all forgiven, then the balance is just a loan with the back at the 1 or 1.5% interest,
Yep.
which will be paid back to your lender, correct?
Right.
Okay.
Right.
All
And
right.
again,
And then,
yep.
mhm.
So
this
I'm on the board of one of the lenders, Greenfield Cooperative Bank. And believe me when I say, we want to forgive these loans, okay? When we forgive these loans, the bank gets their 5% commission. They don't want to service a loan for 2 years at 1% interest, okay? So if you think you're having trouble, I tell you to reach out to your accountant and see if there's a way to interpret things to get full forgiveness, okay? Because that really, everybody wants everybody to have full forgiveness.
Okay. And then, so this person in particular, they did do a PPP and plan on applying for the PPP too also. And so they want to understand how does they want to understand what happens to the amount that is not forgiven.
That you have to pay back. My understanding was it's 24 months at 1%. Okay. It'd be spread out over 24 months and you'd pay it back at only 1% interest. So yeah, it's very, very low interest. Yep.
Okay. And then, will nonprofits, 501c3s be able to do no employees with the 990?
No, they have to have employees because you have to, 60% of the costs have to be employee costs.
Mm-hmm. How do you calculate the monthly amount then?
What's that?
How do you calculate the monthly amount?
Well, they have to have employees to get it. If you don't have employees,
correct.
Yep. It's the amount is based upon 2.5 times your payroll.
Correct. And then this person asks, I can select any quarter and will reflect more than 25% drop. Therefore, I can accept a higher PPP loan amount based on the 2019 number of employees and average payroll being higher than the 2020 average payroll and lower than of employees.
It's your choice. You can use the quarter of your choice. So if you had revenue loss in all 4 quarters, pick a quarter. Okay. That qualifies you for the loan. Then you can you could either use 2.5 times your 2019 payroll or 2.5 months of your 2020 payroll. Also your choice. So if your payroll is higher in 2019, you're going to use 2.5 months of that payroll to determine what your eligibility is.
Okay.
How much money you'll get. When does the interest on a PPP loan start? Is it when you receive the initial payment? I think that's all been deferred to, it's going to start early this year. The interest I shouldn't say that. The payments will start then if you haven't gotten it forgiven. If you don't get it forgiven, the interest will go back to when you get the money. How do we know what are covered operations expense and covered supplies? You're going to have to get into the regulations for that. Like I said, some of the expenses, it's definitely payroll, benefits, utilities, rent, mortgage interest. Those were covered in the first one. They're covered in the second one. They've expanded some of the operations to be covered, including outside accounting to be paid, outside human resource, which I'm not sure how that's defined, but those are other things that they've added. You still have to spend 60% on payroll, but the other 40% can be on any of those items that I talked about. If you didn't apply in the first round, you will use this form for the second round. Yes. Yep, this is the form that everyone's going to use, whether you applied or not. So the W-3, what about using a W-3 for payroll confirmation? Yes, that's one of the ones I talked about. I might have been off the air then, that the W-3 or the 940 federal unemployment tax would all use that for the payroll. And you're probably going to use 2019 because that's probably when it's higher. The monthly income for a sole proprietorship, it's literally your cash receipts for the month. You'd have to break it. You'd have to get into your bank statements And if you reported 100,000 for the year, it'd be how much of that came in each of the 12 months.
Okay, there was one more question here in the chat. Angela had mentioned something, well, you mentioned in regards to nonprofit, they shouldn't be penalized for having subcontractors versus employees. Like if you are 1099 and you Schedule C, so you couldn't be in a nonprofit, use 99 income. I'm not really sure there's like,
Yeah, again, unfortunately, are you
question.
penalized for using subcontractors rather than employees? The answer on this PPP is yes. Okay, that it's not based upon your use of subcontractors. It's based upon the people you have on the payroll. A subcontractor can get a PPP loan, but you can't use a subcontractor's to expense to get your PPP loan.
Here's one more question. If you have a couple of payroll employees and an owner who take irregular monthly draw, how is it calculated?
Again, if you're a partnership and that's how the owner gets paid, you can include that draw. Okay, like we're a partnership. We have employees and 3 partners. The partner's draw is included in there up till the $100,000 limit, just like an employee. That's allowable. That if you're in that situation, you're probably gonna have to talk to your bank to see, and you'd include that in your 2.5 months. But the backup you'd have to provide would be your W-3 plus what you're paying the owner. We didn't have any problem with that the first time. So, and like I said, we have 3 owners that don't get paid payroll, but our draw was covered up to the $100,000.
I'm guessing this is in regards to the PPP. There's a 100K owner draw maximum. The max applies for payroll. Can you also include this as well as Schedule C LLC sole member?
Yeah,
I think it does. Yes,
right.
it applies
So a sole
for anybody.
proprietor would have the same 1923 a week or whatever the 100,000 divided by 52 is. Yeah.
Right.
Yep.
It's per employee.
You're treated the same. A partner or a sole proprietor, someone who can't be on the payroll, is treated the same as an employee.
All right. How would you calculate the monthly payroll section?
I think
is it in this application?
Yeah, you could take your W-2. Okay, you take your W-3, which summarizes your W-2, and divide by 12. That's your monthly payroll. A lot of banks took the 940. So you look at your, 2019 940, which is your federal unemployment tax return, okay, which shows your payroll for the whole year. For 2019, then you can simply divide that number by 12. So I think most banks looked at the W-3, which adds up.
Can you repeat that again? You were lagging for a second.
So that you can either use your W-3 from 2019, which summarizes your W-2s, or you can use your 940 from 2019, which summarizes your federal unemployment tax. Your 941s are quarterly. Your 940 is an annual payroll tax return. And that'll give you your total payroll, and you can divide by 12 to get the average monthly. Okay. So the other one they wanted me to go over was the, this is the grant application that she talked about. It's 1 page. It's an Excel spreadsheet. Okay. And they want you to fill out monthly 2019 gross income and expense and 20 gross income and expense. And again, the 19 should tie to your tax return, but just spread out monthly. Some of the applications they've gotten, the 2019 is not tying to the tax return. Some of these, again, the monthly breakdown here, that's if you have QuickBooks, it's easy. If you're a sole proprietor that only looks at things annually, you're going to have to prepare something going back, looking at your bank statements. And again, they're emphasizing the fact that it needs the 2019 has to tie into your tax return, has to tie into your Schedule C for income and expenses. If you're a sole proprietor, that's your Schedule C.
Correct. And this in this form is very specifically for the Valley Community Development grants that I put on the chat, the website, and that covers the cities and towns that I mentioned earlier.
Yeah. And this deals with both income and expenses. So it's showing profit, where the PPP process doesn't deal with profit at all. It makes no difference what the profit was. So that's a different for these. And I think most of the state grants do ask about that. Okay. So I think this is fairly straightforward, but like, someone asked the question, if you're a sole proprietor, you're going to have to go through your bank statements and determine what your total income and expenses were each month. So that is, again, could be difficult for some people. If you keep your books on QuickBooks, it's all in QuickBooks. You can run a profit and loss and tell it to show you month by month, and it'll do that. And then it's a simple matter of inputting the monthly totals and making sure that they tied to your Schedule C. Massachusetts webpage, there's a COVID page because there's going to be more grant opportunities. That's for sure.
Right.
Especially if the next stimulus package includes more state and city money. There are going to be a lot of grants. A lot of chambers are doing grants. You should be looking at any chamber of commerce that you're members of. And again, it may only be a couple $1,000s, but they're out there, and they're going to go to the people who apply for them. So, but
right. That's the state grant. Unfortunately, nonprofits are not eligible for
not eligible. Yep.
Correct.
Yep. We've seen it's been interesting in the nonprofit world because some nonprofits are struggling. Okay. But other nonprofits have been overwhelmed with some items, so it's been very inconsistent with how people are doing. So, yeah, I'm also on the United Way board in Hampshire County, and that we're doing okay. We could always use more, but it wasn't as big a hit as we thought it was going to be. So, yeah, which is good. Good news. Yep.
So just so everybody knows, so today we covered financials in general. We're covering the Paycheck Protection Program, second draw, borrower application form, and the Excel sheet that relates to the Valley Community Development COVID-19 grants. So we're covering 3 things today.
How's that? Is the PPP back up?
You got it.
Yep. So again, the only thing we're worried about here is the revenue.
Right. And I think that was it. Let me see. Maybe there's something in the chat. I'm checking real quick in the chat. Nope, we're good there.
All right, you got the speed version today, and again, we're always available to answer questions. We do this seminar once a year. We also do a cash flow seminar once a year. And there's a lot of help you can get at this business center. So, all right.
Are you all set with your presentation, Rob? Are we ending early?
Yeah, we're going to be early. I'm glad we got a lot of questions. So, yeah, that's
Holy
good.
cow. All right. So I'm going to share my screen. I'm going to go ahead and share my screen. And I want to thank everyone for attending today's webinar. I'm going to go ahead and remove the spotlight from here. I want to thank everybody for attending today's webinar. This webinar was brought to you by the Western Mass Means Business Collaborative, including SCORE, Center for Women Enterprise, Matthews Capital Corporation, Valley Community Development, Common Capital, Franklin County CDC, and the MSBDC. And we want to thank all of the funders that make this possible: the SBA, the state of Massachusetts, and also UMass Eisenberg School of Management is the host of the Small Business Development Center here in Springfield. I also want to flash on the screen the contact information for all of the folks that you can contact for assistance and, or for further financing, like Common Capital is a local community development financing institution. Franklin Community Development Corporation is the host of the Western Mass Food Processing Center. Here's the contact information for the Center for Women Enterprise as well. They work with a lot of women-owned businesses, and they do a lot of really great webinars. DDICE Valley CDC, that's the organization that's running the COVID-19 grants for Amherst and the other communities that I mentioned. Len Gendron is with SCORE, which also has mentors who volunteer their time to assist small business owners and answer their questions. And Anita and myself, our contact information is there at the bottom. Thank you so much for joining us today. We really appreciate your coming here. I hope you took away a lot of really great information. Rob, tip of the hat to you. Great job.
All right. Very good.
Have a good weekend, everyone.